Hey everyone, it's Mark Ferguson with Invest for More, and welcome to another real estate investing video. Today I'm going to talk about commercial versus residential rental properties, the differences, what to watch out for, which one is better, and what I have invested in myself. So of course, check out investformore.com for more information on this subject. I've got an article I'll link to, have lots more other great articles on that site, and we have a ton of other videos on this channel as well, our fix and flips, our rental properties, and other advice videos. So I will start out with my investing background real quick. I started buying rental properties in 2010, ended up buying 15 single family rentals between then and 2015. I was investing in Northern Colorado, where it's a great market back in 2010. Things have exploded over the last 8 years, and prices got to a point where I could no longer make money with my residential properties. They're too expensive to buy and did not cash flow because rents were not high enough. So I took a little break, was thinking about buying rentals in Florida or other markets, and then I kind of discovered commercial real estate on accident. There's a really cheap property that came up for sale in my area, looked at it, decided to make an offer on it, ended up buying it. And from that point forward, I got kind of hooked on commercial real estate, but it is a completely different ballgame. And I've ended up buying 7 commercial properties the last couple of years, including the 68,000 square foot strip mall where my office is that we bought last year. All right, so I'm going to go over how it's different buying commercial properties, how it's different financing them, different leasing them, different valuing them, and even different selling them than residential properties. And the first thing we're going to talk about is finding the deals, because I'm all about getting properties below market value and getting a great deal on them. When I was buying residential rentals, it wasn't too difficult to get a really good deal on them. We were flipping houses, and it's very similar to flipping a house, except you just keep it as a rental, and you buy it well below market value, have a ton of equity in it. That makes it easier to refinance later on, maybe take money out if you want to. Commercial properties you can also buy below market value, but it's a slightly different process. With most of my residential rentals, we'd buy them from the MLS, maybe they're foreclosures, short sales, even some fair market deals. But with commercial properties, they can be listed all over the place. Some I got from the MLS, some I bought from Facebook. I've bought some as a pocket listing. And you will find that with commercial real estate, especially the bigger deals, they aren't just listed on the market like most houses are. It's more about who you know and networking. Commercial real estate agents work much different from residential agents in my experience. It's kind of like, well, I sort of know of a property for sale, but it's not really for sale. It's not really marketed unless you know the person who knows the person who owns it. And it sounds kind of crazy, but it really does work that way on so many different properties. And it kind of works that way a little bit the multifamily residential sector as well, where these really good deals aren't exactly listed for sale anywhere. It's kind of like, well, I know somebody who knows somebody who might want to sell one. Or maybe if you send the right marketing material or meet the right person, you might find a really good deal. And that can be frustrating at times, but it can also present a lot of really good opportunities. The property I bought that was a big $2.1 million property was a pocket listing. It wasn't listed anywhere. An agent was representing the seller, and that agent just happened to be the person who I had talked to help me find some of these deals. Because even though I'm a broker, I have my own office, I've been an agent for 17 years now, I knew that I didn't know enough about commercial to go do it all on my own. So I enlisted the help of another commercial agent with some of these big properties. And he happened to have this deal come up. He told me about it first, got under contract, bought it, end of story. It never hit the market. Nobody else really knew it was for sale. And we think this property is worth well over $3 million now, if not more than that. And we bought it for 2.1 a year ago. It was just a fantastic deal. I wish I could find 10 more of them, but they aren't just sitting around there waiting for people to snatch them up. You have to work to find them. And that's something you'll find with commercial is you will see properties listed. They'll be on LoopNet, which is a site that lists properties kind of like MLS, some other sources, but they're not all in one place either. If you're looking for a residential property, most of them are on the local multiple listing service, or MLS, that residential agents use. But commercial agents will use LoopNet. Some will use another site that just went under, Excelsior, something like that. Their own website. They'll simply put a sign up. Sometimes they do use MLS. They're all over the place. So you kind of have to check multiple places. That's why networking is so important in this business, and kind of letting people know you're looking, letting all types of different agents know you're in the market. And that can sometimes get you a better deal than searching on your own. And that's how I found a number of deals myself. But at the same time, I bought some really cheap $100,000 commercial properties that were listed on the MLS too. And it's kind of funny because when I bought those properties, I always act really fast when I buy properties from the MLS. If I see a good deal, I go see it right away. I send an offer right away. And it kind of almost surprised the commercial agents when I send an offer and the same day a property is listed. They're like, "What are you doing?" I'm like, "Well, I'm making an offer. I want to buy this property." They're like, "Yeah, but it's just listed today." I'm like, "I know. I want to buy it." They're like, "Well, the seller might not be able to review it for a few days. There's really no rush." I'm like, "I want to buy this property. It's a full price offer. Can you send it?" Like, "Oh, it's full price? Oh, okay, yeah, sure. Well, I guess we'll talk to him." And there's a complete different sense of urgency on a lot of these properties than there are residential properties. And you see that even the offers, sometimes we've made offers on bigger deals and it's taken weeks to get a response from the seller, and nobody thinks it's a big deal. And it's just like, "Oh, it'll happen, and it happens." And my mentality, that drives me crazy. So there's lots of things to be prepared for when you're buying commercial versus buying residential, and it's just totally different. And you'll also find there's huge price ranges too based on the property. So residential properties are kind of valued on the single family homeowner market. What a family will pay to move into that house. In most areas, some areas will base it on income if it's rented out in certain areas, but most areas it's based on what a family will pay to move in there. So you can base it on comps, see what other houses have sold in the area. It's not terribly difficult to value a property once you figure out how the comps work, once you figure out kind of like how an appraisal works, how people value the properties. Well, commercial real estate is completely different. It's usually based on cap rate, which is the net operating income divided by the value or cost of the property. And net operating income includes, is the gross income minus all your expenses, not counting the debt service. So you don't count any loans you have. Just, if you bring in $50,000 a year in rent, and you subtract your property taxes, your insurance, your property management, any maintenance, and then you come up with your net operating number, and you divide that by the cost of the property. That gives you a cap rate. It's like in our area, it's common to see 6 or 7% cap rates on commercial properties. And that's pretty low, which means commercial properties often don't make a whole lot of money. But the higher the cap rate goes, the more money you'll make. So the property we bought, the big one, was about a 9 cap when we bought it, which was a great deal. Loved it. And that property is now an 11 cap based on what we bought it, because I became a tenant. We cleaned up some other expenses. It's awesome performing, while there's still properties out there listed for sale at a 6 or 7 cap. So we can value our property based on those market cap rates and figure out, hey, this property is worth a lot more than we paid for it. But at the same time, every commercial property kind of has a different cap rate. People determine the NOI differently, so it can get very confusing valuing those properties. Like a Wendy's that's a very solid franchise, has a 20-year lease, might sell at like a low 6, even a 5.5 cap rate. Whereas a vacant warehouse with no tenant that's kind of run down, you're kind of guessing what it's going to rent for. That might sell for a potential 10 cap once you get someone in there rented. But you've got to do all this work to get it rented. Maybe you have to fix it up a little. Who knows how long it'll take to rent it. And that's why the cap rates are so different. The values are so different with commercial properties. And that creates opportunity. That Wendy's is almost a guaranteed return, not quite, but really close to a guaranteed return. And the big kind of commercial investors will buy that knowing they've got this return coming in that's pretty solid, pretty decent investment. People like me who want to add value, want a really, really good investment, will go after the value add properties where maybe there's vacancies, there's some work needed, there's really low rents, or something else is wrong. And that's where we can add opportunity. The property we bought, there wasn't anything terribly wrong, but it had 2 vacant units and it had a grocery store in it, which paid really low market rent. We didn't raise their rents, but it's still a really good deal. It was still a 9 cap with the current tenants they had in there. And that was part of it being a pocket listing, just having that connection. And then once I moved my office into one of those spaces, I was paying rent to myself. I had a partner that helped me buy this property. We increased the income by like $3,000 a month. All of a sudden, the cap rate jumped up, and we have another vacant space that we're working on getting a lease signed. We might bring in another 25, maybe close to $3,000 a month once you count the triple N costs, utilities, and things like that I'll talk about too. And it could be an even higher cap rate. So that's the cool part about commercial, is while it's very confusing valuing these properties, because different sectors like industrial versus retail versus a restaurant versus a gas station versus a car dealership will all have different cap rates. Because it's so confusing, sometimes you see properties that are undervalued, you see opportunity, and if you know your stuff, you really know your market, you can make a lot of money. But it's not something that the brand new investor probably wants to jump into without doing an incredible amount of research or getting help from some really smart people who know the business. It took me a long time to figure it out. I'm still learning now just all the intricacies about commercial real estate. All right, so buying it's completely different. Valuing it is completely different. Leasing it is completely different as well. And actually, before we even get to leasing, I'm going to talk about repairs real quick, because that's something that kind of blew me away too. On residential properties, we have our contractors, employees that work for us who do work on flips and some of my rentals. Pretty straightforward. We get really good deals. We have to make money in this business. Well, I started getting to the commercial arena where we had some bigger properties, and I was getting referrals to these different commercial contractors, and I could not believe the prices, the process. It was completely different. You get these giant commercial contractors, and they're basically charging 20% just to manage the project. Their companies don't do any of the work. All they do is find subs. And they're padding their numbers like crazy to make sure they don't miss anything. And you're paying just literally 2 to 3 times as much money for the same work as I would pay my residential guys. And over again, it happened all over the place. And really, I started going to my residential guys and I'm like, hey, can you guys do commercial work? And we figured it out. We got it done because there's no way I was paying commercial contractors as much money as they needed. And luckily, I haven't had a huge job on a commercial property that would need a giant company like that. But the thing is, they know there's a huge need for them on those giant jobs because they can get it done quickly. They have a process to oversee everything. Whereas on residential stuff, it's smaller, not as big a deal, so it messes up. So that can be a huge cost if you're looking to repair commercial properties and you're using straight commercial people. Be prepared. I think one thing that blew me away was the local country club, which is about 19,000 square feet, was paying $400,000 to replace their HVAC system, which they weren't going in and reducting everything or tearing out walls, just replacing the roof units, the AC units, and it was a huge exorbitant charge that shouldn't have been done like that. But anyway, you see that all the time in commercial, so be careful. Now, moving on to leasing, completely different. So residential property, you're usually doing a 1-year lease. Maybe it's a few pages long to go over the ins and outs, no smoking, late fees, how the house can be used, no illegal activities, things like that, the deposit, if it goes to a month after it's done. On the commercial leases, some of the properties that we bought already had leases in place. I had some leases done online for another vacant space I had. They're literally 50 pages long for the leases. They have like 70 different sections to go over for all the different things that happen with commercial properties. And that's something else can be really confusing and really tough to figure out when you're brand new. You have to go over the lease term, which is usually not 1 year. It's usually 3 years or 5 years or 10 years. Like I said, with the Wendy's, it can be 20 years long. Every year you have rent escalators, which bump the rent a certain percentage, maybe 3% a year, maybe 2% a year. You've got different deposits. You've got what is called triple N versus a gross lease. So with the residential property, it's pretty clear. Hey, you pay rent, you pay your utilities, you mow your lawn, you do all that stuff on a single family home. If it's a multifamily, maybe the landlord will mow the lawn. Maybe he'll pay the water bill. On commercial, it's different on almost every single lease. And a triple N lease is something that you see a lot, and it basically means the tenant pays everything. So the tenant pays utilities, they pay for their own maintenance, they pay for the maintenance of the property if something happens, they pay for the parking lot maintenance, they pay for cleaning the parking lot, they pay the property taxes, they pay the insurance, they even pay management fees. So a triple N lease pretty much means the tenant pays everything. But then you've got to figure out those costs. So you've got to add up all the costs, the insurance, the property taxes, and figure out a number for what that tenant pays. And kind of every year go through, make sure the triple N costs are what they should be. Maybe you have to raise them a little bit one year to make up for higher costs. And you have to kind of reconcile that with the tenant and make sure they're cool with it. On top of that, maybe they've got the utilities in their name, or if you're paying the utilities, you have to divide them up or divvy them up based on a percentage of what space that tenant has, or if they're paying for all of them. All kinds of things that can go into it. And on top of that, then there's TI. And I remember going to a meeting for a big property, and the broker started talking about TI. And I'm like, I don't really know what this means. I'm like, TI is like principal, interest, taxes, and insurance. I'm like, oh, they must be talking about taxes and insurance. Okay, I know what they're talking about. And they kept talking about some other stuff, and my partner was with me, and we walked out of the meeting, and we're both like, I don't know what TI is. He's like, I don't know what TI is either. So I looked it up, like, oh, it means tenant improvement. I was completely wrong. Had no idea what we're talking about. So when you lease a commercial property, a lot of times the tenants will ask for improvements to be made. So like on the building we bought, a restaurant had moved in a few years earlier. They had the landlord paid for $150,000 worth of tenant improvements. So either the tenant gets the work done or the landlord gets it done. And they came in there and they painted, they did flooring, they did HVAC work, redid the bathroom, spent all this money making the restaurant nice for the restaurant. And then the landlord actually paid a bunch of that money. In return, they got a 5-year lease, pretty decent rental rates for having that tenant in there. And a lot of times you'll see TI included in the leases. Either the tenant pays all of it, or the landlord pays all of it, or it's split, or the landlord pays it up front, but then they charge it back to the tenant with higher rents. All kinds of things that can be done. And you'll find just some tenants want a ton of TI, some don't want any. And we had a laundromat who wanted to lease one of the vacant spaces in our buildings. And they basically wanted $300,000 worth of work to be done, and they wanted to sign a 10-year lease. Well, on that 10-year lease, we probably would have made just over $300,000 for the entire lease term. To me, that is not a good deal to spend $300,000 to maybe possibly make it back in 10 years. Obviously, that didn't go anywhere. We have some other people we're talking to, but it's all kinds of things to look at like that. And on top of, paying TI, having these other things come up, you often have agents involved when you're leasing commercial properties. When you're leasing residential properties, a lot of times it's just the owner, the landlord, or maybe a property manager trying to lease it. They put it on Craigslist, put it on Zillow, get a tenant in there, pretty simple. Buyer usually, or the tenant usually doesn't have an agent representing them. But when you're leasing commercial properties, a lot of times the tenants have an agent, and you have to pay that agent as well on a lease. And you pay the whole term of the lease. So I was working on a commercial property I have in another town. It was about 3,000 square feet. Had an oil company come while we were working. I said, hey, is this going to be for lease? I'm like, yes, it is. And it's awesome. We ended up getting a deal together. They had an agent, and we paid that agent, I think it was a 3% commission based on the entire lease term. So not 1 year, but it's a 3-year lease. So you add up the 3 years times whatever they're paying every month, and that's what his commission was based on. So you're paying a pretty hefty upfront commission if they have an agent involved. Something else to consider with commercial properties and leasing those properties. Like I said, totally different, and how that lease is structured, who pays the costs, all change the value of a property because it changes that NOI number, the net operating income. I mentioned a gross lease a little bit. That's basically where the landlord is paying a lot of those expenses. So I have a gross lease on another rental property, the one we're just talking about, and I pay the utilities, and I take care of the exterior maintenance. I take care of the parking lot. We shovel the snow. but we're charging a much higher rental fee because we're paying all those costs than we would if it's a triple N and the tenant was paying all those costs. So it all evens out, but a lot of things to consider. All right, so something else to consider are the financing differences. Rental properties, when you're buying residential rental properties, single family homes, they can be fairly easy to finance, especially your first four. You can get 30-year mortgages, you can use local banks, even some big banks. Once you get more properties than that, you usually have to go to the local banks. But again, I'm getting 30-year amortizations on my residential properties, even when I had my 15th. Well, I switched to commercial, and all of a sudden the loans completely changed. I had a 30-year am with no balloon, which means I could keep that loan for 30 years, never had to worry about it getting called due, although the interest rate could go up. Well, you come to commercial properties, and all of a sudden the lenders are talking about balloons, variable rates, 20-year amortizations instead of 30. It all changed quite a bit. So that's something else to consider is your cash flow may be lower because the loan term is shorter. The shorter the loan term, a 20-year versus a 30-year, it's going to have a much higher payment because you're paying interest and principal over a shorter period of time. Your cash flow is going to be lower. So I think we got a 25-year AM on our big property, like a 4.6 interest rate, great rate. But we can't keep that loan for 25 years, or we probably couldn't because there's a 10-year balloon payment. And that means after 10 years, the lender can call the note due, say, you have to pay it all back, you have to refinance it, you have to sell the property, what you have to do, you have to pay this back in 10 years. A lot of them have 5-year balloons. I even had a lender try and do a 3-year balloon on one because our lease was only 3 years. So lots of different things to consider when financing commercial properties as well. It's usually completely different than residential properties. I have the same lender on my residential properties as I try to do on some of my commercial stuff. I'm like, hey, I'll do my 30-year AM, have this great loan. And they're like, nope, sorry, it's commercial. We're doing either, I think it's a 20-year AM or a 15-year fixed. And totally different loan than what I was used to. And that was a big surprise for me. It's something you need to realize. And the lenders also will base a lot of their loan determination on the cap rate, the leases, the tenants. They do not like to lease on vacant commercial properties. It can be very hard to find new tenants. That's something else to think about is, there's a lot of people who want to rent houses. Not a lot of people who want to rent commercial spaces. It can literally take years to lease some commercial properties. Other commercial properties, it might take weeks. And it's hard to know exactly how long it'll take. And that's something else that you really have to be careful of. You need a lot of cash reserves, a lot of, patience to deal with commercial properties that are vacant. And that's why the solid long-term lease commercial properties are worth so much more money than the vacant or kind of shaky leased properties are when you're dealing with commercial real estate. All right. Selling properties. Kind of the last thing I want to talk about here, commercial versus residential. When you're selling a residential property, as I said, the value is based on what a homeowner will pay. And you have lots of people who will buy residential properties in most cases. You've got some investors who might be like you, wanting to buy a rental property, and you've also got homeowners. Homeowners always want to buy properties. Even in a down market, even when things are going horrible, they still want to buy. That's not always true with commercial properties. You only have one buyer with commercial properties, and that's another investor. Maybe you have someone who wants to run a business in there, but again, that's still kind of an investor if they're buying the property and leasing it back to themselves or using it as an owner-occupied business. That's kind of rare, but it does happen. But usually the person you're renting it to is an investor. And if the market is really down, if you're in a bad economic downturn, it could be very hard to lease commercial properties. You have to be very careful and be able to ride out those storms because selling them, like I said, can take a very long time. I have seen commercial properties for sale for years. Mostly maybe they're vacant, maybe they're just trying to push the price really high. Who knows why? There are commercial buyers out there. There's people buying commercial properties all the time, but it takes sometimes 6 months, sometimes a year if you really want to get top dollar. If you're willing to let them go at a bargain, you can sell them quickly. But if you want to get top dollar, it takes a lot of time. They usually need to be rented, have really solid leases in place to sell those commercial properties. All right, I think that's all I've got. What I want to talk about today a lot that goes into buying commercial properties, a lot to think about. We've gone through quite a bit with buying them, rehabbing some properties, leasing some properties. Some of our smaller commercial stuff was pretty easy to lease. Some of the bigger office space stuff, not quite as easy, but we've all kind of got it done. And financing it, same thing. Some of the smaller ones are easy to do, the bigger ones a little tougher, but we've managed to get it done. They've been fantastic money makers though, great cash flow, great deals on the property we got. A few of them I've been able to refinance after buying them, take all my money back out and still have great cash flow. And it's just been a great business to be in. We're still buying, still expanding, just bought one last month. It's kind of a 4-unit that's 1 commercial space, 3 residential. So we'll see how that one goes. All right, thanks everyone for watching. Again, please leave a comment, question below. Give us a thumbs up if you like this video, if it helped you out. And be sure to subscribe for more videos like this or more videos on our fix and flips. We've got a few more being finished up we'll do soon. Our rental properties, all that good stuff. All right, thanks a lot. We'll talk soon.